talk to you.
Thank you for joining us for the venture capital panel.
I don't think that works.
How many companies in the room are raising money?
I think.
Okay. Thank you. Hey, John, how are you? Good to see you. Mariana Danilovic, I'm a managing director of Transform Group, which is Mike Turpin's a company that has many different interesting assets. I also get to manage something called Bid Angels, which is a global network of events, angel events, and crypto events, investing in blockchain companies globally. We have about 6 chapters launched already, and we're looking to launch about 30 by the end of the year. And the most interesting thing about that network is that it was originally online, and few hundred of the top tier crypto investors and early entrants on the planet are in it. So it's quite a privilege to work with all of them, and certainly with Mike. So we have a panel of people who have all been venture capitalists, with the exception of Max. That's why he's late. He's going to pitch to them today. No, I'm just kidding. Hi, Max. Everyone on this panel is actually a member of a venture capital, or is part of it, is a general partner in a venture capital fund, and they have some additional assets to that they're working with. So Randall Crowder's been in the venture capital business for about a decade. He's invested in Funware, which is also has a token that's doing quite well, and has many other assets. And I would say, if I started going through their backgrounds on the panel, we won't have any time for them to speak. So I'll let Randall start.
Oh yeah, no. So yeah, I hate free time, and I collect jobs I'm probably not qualified for. So, but it's been about 10 years as a VC, mostly in health tech and blockchain, and then basically left the dark side to get back in the ring as an operator. So Funware is an Austin-based company, been around for about 10 years. We built the first NFL app, the first NASCAR app. We built all of Fox's media apps, so any large kind of enterprise-level mobile ecosystems. We're kind of pretty much one of the leaders in that. We also one of the leaders in indoor location-based tech. And so right now we've kind of pivoted into a software as a service business where we're licensing a lot of our software to other people that are launching their own kind of mobile experiences. And so with that, blockchain became an interesting asset to be able to enable brands to introduce crypto to their kind of consumers and to their ecosystems without having to go through the rigmarole of dealing with the SEC and doing a lot of other things. So kind of cracking the code on bringing consumer-facing mobile applications, marrying that with blockchain or digital assets, and then creating more customer stickiness. So today we generate about 5 terabytes of data every single day. We see about 1 billion active devices on our platform every month, and we're using that scale to give brands a different way to connect with consumers and give Facebook and Google a run for their money. So we'll see what happens.
We're rooting for you. Krish Lautekar is kind of like me, a recovering investment banker and a VC, and still a VC, with a seed fund, but also in the digital media and entertainment space. Running 2 companies at the moment, one on the purely digital media entertainment side, and one of my favorite companies I've seen in the blockchain to date, you hear it here first, called Superworld, which is a way to tokenize Second Life. And
my
more.
Too.
Yeah, I love that.
He's in Austin. I had to come all the way out here to meet him.
We're launching Austin, Texas chapter for Bid Angels. A little Austin, Texas promotion here. Go ahead, Rich.
Yeah, thanks for having me, and it's a pleasure to be here, and looking forward to meeting everyone. My background, as was stated, is management consulting, investment banking on Wall Street in New York, doing mergers and acquisitions, and then venture capital in New York across biotech and tech. I launched a venture capital fund in Europe and Ukraine about 8 years ago, investing in early stage technology companies. I was early at Top Talent. It's an Andreessen Horowitz company that we scaled. It's providing elite engineering resources to companies around the world, and now elite talent, engineering, business people, and designers, and soon to be other categories. And about 3 years ago, I started Rogue Initiative Studios. What we do is create new original content that goes across feature film, television, gaming, virtual reality, all the way to amusement park rides and toys. My co-founder produced Call of Duty, and my other partner is Michael Bay, the action director, along with Linda Obst, and my other co-founder, Kathy Twigg was at Sony and MMTV and DreamWorks as well. Currently, I'm working also on Superworld, and Superworld's an augmented reality platform. It's all around us right now. We're in it. You have your world, I have my world, I can see your world, you can see mine. Brands can have worlds, and then you can buy and sell the worlds. You can buy this place or downtown LA or downtown Moscow or New York, anywhere you want. And when you own the land, you get a share of the commerce. And then we've opened up the digital land so other apps can build on top of it. So it's all on top of us. So it's second life on top of the real world, or Ready Player One on top of the real world. Or another way to think about it, it's Foursquare meets Pokemon Go meets Monopoly.
And I feel like I want to live in that world. Michael, and I live somewhat in that world with Michael Turpin, who's, I think, founded every blockchain company on the planet that's still in existence and thriving and has a chance of being a Fortune 500.
Didn't found them, but worked with about a third of the coin market cap. So I, from the investment side, my first company was the Turpin Group in the 1990s. We worked with a lot of the dot-coms. We were agency of record of America Online. Greenhouse launched the Motley Fool, Earthlink, a few other places, and that's when I got into angel investing. Had a cover story in Inc. on me about how entrepreneurs can make money investing in companies that they work with, and sort of got the venture capital model of having 9/10 of them being losers and still making money because you got one that did a 50x. And in my case, the 50x was Zoom.com, which went public and got up to a $7 billion market cap at one point. And we had a few other 5x's and 2x's, and the rest of them just died horrible deaths. But that's a model if you can really find that one big one that venture capital lives by, and that really is from angel investors all the way to Sequoia Capital. I sold that firm into a roll-up in late 1999. At the same time, I spun off something that I had incubated in the agency in Marina Del Rey called MarketWire. Actually, it was called InternetWire at the time. It was the first internet-based press release distribution company. I raised angel money from one of my clients, the one who had the 50x. He had some spare cash sitting around. And then we ended up scaling with our A round from Sequoia Capital and Hummer Winblad. Did a deal with an investment from NASDAQ when the dot-coms crashed, and our competitors, PR Newswire and BusinessWire, were calling us the Newswire of dead dot-coms. And meanwhile, our biggest clients were Cisco and Merck and not dot-coms. So when we became MarketWire and had NASDAQ as an investor, all that criticism went away. We sold that company in 2006 for $35 million. It got sold then again for $100 million a year later. NASDAQ then bought it because they gave us a lowball offer the first time around for $200 million, and they just sold it last year to Apollo for $335 million. So it keeps bouncing around and growing. Unfortunately, I only got the first check. So. But usually venture capital does not do creative deals where you get to keep part of the company and things like that. So as an entrepreneur, you have to sort of think about who and what type of capital you want to raise, and and how long you want to bootstrap, which is usually the longer the better. Currently, in addition to my work at Transform and through Bid Angels, which is not a fund, although we did have a Bid Angels fund that was the first digital currency fund in early 2014. Myself and David Johnston, who's now with a family office called YCG, and he's the chairman of Factum and a very active angel investor. We started the first digital currency fund. We raised $6 million, all of it in Bitcoin and Counterparty and Mastercoin, and we invested $1 million in Ethereum at 30 cents, so it did pretty well. And also in MadeSafe and Factum and Storage and some of the other really early, moonshot tokens. And I live in Puerto Rico, since there's no capital gains taxes there. I was the first person from the crypto community to move there. And in addition to my work at Transform, which is 99% of my time, I spend another more than 1% of my time as a general partner at Alphabet Fund, which is a digital currency hedge fund, $400 million under management, based out of London.
So we continue on. Thank you, Mike. To Max, who is the co-founder and CEO of Scent. And the most interesting thing about Max Brody is when I met him and he told me the pitch about this company, it was one of the fastest grasping things that I've ever heard. It's like, oh, I get that. That needs to be done. So it's really reimagining the influencer space and how the economy, shared economy experience in that space should look like. And it wasn't really obvious that this should be done this way, but when you explained it, now it's like the only way I think about it. So Max, you want to tell us about it?
Thanks. Yeah, so I run a company called Scent. We've largely, right now we're one of the most used crypto content networks in the world, and largely that's because we've essentially pioneered a fundamentally new way to monetize content, or really anything digital. Essentially what it is people can post things like they would elsewhere, but rather than paying for something or hitting a paywall or subscribing in some monthly fee, they can essentially bet on its popularity. So how that works is they seed it with money. That's what we call the process. So you see something like a cool song or a cool video, you can seed it with, say, $5, and what happens is that $5 gets distributed to the creator, but also to everyone who came before you that seeded the same content. So you're sort of betting on the fact that people are going to come after you and seed after you, and you'll make a financial profit by investing in creators and creations that you believe in. And we think this is sort of a new category. It seems to work really well. Users are already making hundreds of dollars per month just from, some users have made over $1,000 per month just on speculating on content. And they're making the money. The key thing is that they're making the money in a way that is in no way work. It's sort of just experiencing content and betting on your taste-making abilities, which we think kind of coincides quite well with where the world's at right now, and how people are leveraging their own perspective against the whole collective content generation of everyone. And so, we're right now we're built on Ethereum, which is a popular blockchain, but we're moving more and more into the mainstream world, and making a lot of moves over the next 12 months to really attempt to be one of the next major networks in the world, alongside Instagram, Twitter, and whatnot.
And we hope you get there, and we like your ways of getting there. So Ben Tsai, last but not the least, is a venture capitalist and also co-founder of the LA Blockchain Lab. LA Blockchain Lab now has entered into an agreement with the city, and they're launching an innovation center with the mayor's office, among many of the accomplishments of the lab. And Ben's going to tell us a little bit more about him and the fund in the lab.
Great, thank you. Yeah, hi, my name is Benjamin Tsai. I'm a co-founder and the CFO of the LA Blockchain Lab. It's a nonprofit organization that's trying to bring academia and government kind of properly into this space. We work with UCLA, USC, UC Irvine, Caltech, which are officially our partners, along with the City of LA, Mayor Garcetti's office. So we've been quite active working with all the different counterparties with conferences and meetings and so forth. Separate from that, I'm also the president and managing partner at Wave Financial. We're a VC firm that is relatively new, but it's a spin-off of an existing VC firm, Wavemaker Partners, who's been around since 2004, $500 million of under management, quite a luminous LP pool. So separate from all of that, just in terms of my background, I come from a finance background. I spent 15 years in finance in Asia, Tokyo, Hong Kong, Singapore. I ran the structured products business for Bank of America Merrill Lynch, and then also ran the commodities desk across Asia. That's it. So looking forward to answering some questions all of you may have.
So coming from such stellar backgrounds, all of you, blue chip, top tier banks, top tier VC funds. Why are you in blockchain space now? I want to just start with that.
I think it's the future. I think that everybody talks about the internet. I think blockchain will be the most transformational thing to touch the global economy since the Medici's commercialized double entry accounting. Internet governing the transfer of information, and I think we're moving away from just calling it blockchain to just digital assets, but, the ability to efficiently manage information. For us, we have to do it. It's the right tech at the right time. So we're trying to do, engaging brands and consumers at kind of just microtransaction level in what we do with these loyalty programs for certain mobile ecosystems. We just can't do it with fiat. The transfer fees would kill you. And so this digital asset, this new technology allows us to deliver a certain experience to our consumers for our brands that we couldn't do before. And then just for us, and I also kind of say this a lot of times, the flip side, I think a lot of people thought of blockchain as being this, oh great, it's anonymous, we're going to overthrow the man. I totally disagree. The man's been the man for a long time, and the man will be the man long after blockchain's adopted. But what it allows us to do is so much better. I mean, for us and brands, it's actually the opposite. It's not the anonymity, it's the accountability, it's the transparency, it's the verifiability, it's the auditability of all this stuff. It's a game changer. And so you see as we move away from the negative connotation of crypto and even blockchain to just nobody talks about TCP/IP, nobody calls that a cell phone anymore. It's just a phone. And so what these different technologies will allow us to do once these things kind of cross into mainstream adoption, they're going to change everything.
Yes, Ben?
Yeah, so I'll throw in a story. Hopefully it's not too long. I speak with a lot of finance people who don't care as much about, wealth for the masses and all that great stuff. So they're more caring about efficiency of systems and so forth. And you hear in the news the likes of JP Morgan and all the big financial firms are looking at using blockchain and so forth. And, the answer comes down to it being a lot more efficient. And this is kind of a two-part story I tell to people. I used to work for AllianceBernstein and ran alternative investments there. And they captured a huge market in Taiwan because they went from quarterly dividends to monthly dividends. And it was very painful for them internally because they basically had to do the same process 3 times as often, writing out checks, wiring, and making sure who the investors are in the whole 9 yards. Had to staff up in the back office, new systems develop. It was kind of a pain in the butt. But because they capture market, all their competitors had to come and do the exact same thing just to keep up and not even capturing the market and incur all the costs and all that. So that's one part of the story. And the second part of the story is I was with with Jamie Finn, who runs Securitize. They're a securitization platform. They create tokens that represent digital securities. So my question to him was, well, how much does it cost for you to push a dividend down your digital securities? And he gave me a blank look. He didn't know what I was talking about, so I kind of explained it again. And he said, well, let me give you an example. We have somebody on our platform that's a mining company. The ownership of tokens that people have represent, shares in this mining operation, the digital mining operation. So they would basically mine and they would distribute to their holders. I said, great, so how much does it cost for them to do that distribution? He says, well, they mine every day, and at the end of the day, they pay the dividend out. Is that often enough for you? And basically, the cost is near zero. And it's not exactly zero. I mean, I went looked it up, I think, earlier this week, just kind of for this discussion. The cost of transfer is extremely, extremely low. I was looking at Ethereum, which Securitize is based on. I think it was a difference between maybe 2 to 8 cents. I think 2 cents would get you done really quickly. 8 cents would take a little longer. A little longer was 18 minutes. So, it's really short. And it's a significant impact for the finance world. Right now, you have, stocks paying dividends, maybe, once a quarter, if even that, maybe once every 6 months. And some stocks don't even pay dividend. They have a dividend, they have an X date, they have a record date. They do all of this because there's a long lag of recording who owns what and so forth and making sure everybody gets the right thing. They would cut a check, print it, mail it out. Somebody would pick up that check and then cash it out. I mean, a lot of that is automated, but there's a pretty long cycle with that. Where in the digital world, it's just done. And, if you want to be cheap, it's 18 minutes. So, yeah.
So I'll be a little contrarian and say that most disruptive technologies are initially about overthrowing the man, especially if the man deserves to be overthrown. That starts with Gutenberg. People were not allowed to read unless it was official scribes. The Gutenberg printing press was very controversial. You could be put in the stocks for reading books. And and then you go to the fax machine, which was at its time a revolutionary technology, because that's how the Berlin Wall came down. People were not allowed, you could tap phones, you could go and block airwaves of radio. You could not stop everybody in a country from having access to a phone line without shutting down the entire system. And that's how the Berlin Wall came down. And then with social media, that's how Arab Spring happened. I mean, everybody had Facebook, and they would just start talking about it on Facebook about, we're going to all meet in the square. So the internet in its beginning was very disruptive, and it was very libertarian. The Electronic Freedom Foundation, one of the main mottos was, the internet sees censorship as damage and routes around it. Today you've got, Facebook and Google and Amazon and the stacks that are built on it as mainstream businesses as you can possibly have. Back in the 90s, there was a big effort to try to stop anybody from advertising on the internet. And I had a client in those days that literally got their fax machine burned up with black paper and I had a reporter tell me, I think it's immoral to advertise on the internet, and they went and talked to my client. And now, obviously that's not mainstream, and the largest advertisers in the world are Google and Facebook, so it's accepted. So most disruptive technologies start out about what you can do to really disrupt systems for those who are out of power, and I think, the real initial purpose of Bitcoin, which is the mother of the blockchain, father and mother and Holy Spirit of the blockchain, was really to make sure that the 2008-09 crisis gave, when it happened again, you had a way of being able to go and move money around the globe in a decentralized fashion, person to person, that could not be stopped by banks. On top of that, if we're looking 20 years in the future, the banks will be using it, and everybody will be using it, and we'll never think of a day that we didn't have it. So I'm in it because it's hugely disruptive. I've been in it since early 2013, and wish I'd been in it 2 or 3 years earlier. The amount of innovation that you can have on digital assets, blockchain, and aligned technologies is sort of, this exponential growth over the internet was really, about digital files, and then you had digital communities, and now you have digital assets. And the difference between a digital file and a digital asset is if I take a picture of this room and I put it on Facebook, 2 billion people can see it, I still have the original. You don't want to do that with money. You don't want to do that with a share of stock. And so with a digital asset, Bitcoin proved that it could go without any third party and take something of value and send it anywhere in the world and be provable that I no longer had it and you had it.
And that's a huge innovation in terms of just kind of like a next generation of digital progression, almost like multidimensional in essence, which is why the blockchain space will shift everything that we do, like internet did, but with more factors and dimensions, right? So in terms of the way that the space is being funded right now, what are some of the business models that you're seeing for funding, and what are your thoughts on, ICOs, STOs, equity raises, IEOs, all the different acronyms of fundraising in the blockchain space? You want to talk about it, Krish? Yeah.
Sure. I think there's, on the funding side, a variety of ways that companies in the space are being funded. I think in our case at Superworld, we're doing an equity raise, but we're also doing a sale of digital assets on our platform. So we're doing AR real estate, which is sold as an ERC721 token, so a digital collectible that you can buy and then reprice. If you're the owner, you get a share of the commerce that happens on the digital land that you buy. And so we're kind of using a hybrid way of raising capital for the company. Equity raise, traditional venture capital, but as well as on the blockchain, selling these digital tokens, and we can book that as revenue when we sell those. There's a variety of other ways out there, and I think as the industry evolves, there's going to be new things that are coming out, like IEOs and other things that are going to be great ways of raising capital from the general public. So.
And just so we have at Cent we have a similar structure. Well, we're only doing an equity raise, but we thought about at the beginning doing a token. We had created this whole token model, and I'd seen with a lot of founders that I know that you like the idea of a token, and then you launch it, and then you don't fully realize that you're sort of having to create a whole monetary system, like a whole world, and there's a million ways it can be attacked, and from what I've heard, you sort of need to spend a huge chunk of company resources just making sure like your treasury is safe, and like all these other things that are completely unrelated to the product. And so we eventually decided to just do it equity, just because that's where the world's at right now. I don't think that's the end state. I think the end state will be some sort of tokenized equity something. But I think right now it's most important, if you're, at least from the position that I'm in of building an app, of focusing on the actual like experience of the app and getting the app into culture rather than trying to recreate money. But to touch on the previous question, I definitely think I'm with Michael in that it's very much about overthrowing the man, but it's about overthrowing the man in a way that doesn't like destroy the whole world. And I think that's what blockchains can enable, because it enables value distribution and creation to be not simply taken from the government and given to somebody else, but to, if programmed well, to be redistributed in a way that still rests on your personal ability to create value, which I think is a real innovation in the space. And yeah, I think there's just going to be a lot more people thinking about what is value. I think on a philosophical level, that's another reason I'm in it, because I think it sort of has forced culture to ask that question. And I think we're not fully decided on what that answer is, but at least we're thinking about it.
Yes.
I was going to say, I've spent most of my career in PR, so I recognize good PR, and I also recognize disingenuous propaganda. And so most of the negative things you hear about Bitcoin have been like, sort of stoked by the JP Morgans and the Jamie Dimons, and, with one side saying like, hey, I'd fire anybody who's trading Bitcoin, and then you find out they bought $90 million of the Bitcoin in another division when his comments made the price of Bitcoin go down. So I think we're very early in the space. Anybody who tells you ICOs are dead has not been looking at the numbers. We have a client who raised $50 million in an ICO just 2 months ago. Most of it's happening outside of the United States because the SEC has decided to just simply throw a lot of FUD out and not make any rules. They haven't made an overarching system of rules since 1934. It's kind of time to update the Howey test, which was about how you determine whether oranges versus wine are commodities or securities, from a 1946 Supreme Court hearing. That was not only before the blockchain, before internet, that was before television became mainstream. So I remember in late 2002, someone telling me the internet was dead, it's never coming back, and internet advertising was a stupid idea to start with. Google went public 2 years later. So this is all very cyclical. At the moment, we advise clients to really look at what they're really trying to do. Some token sales should never have been token sales. If you start with the token, it should be something that is, and this is where I think the laws in the US are going to evolve, like they have in Wyoming and in Colorado, which is, it shouldn't be just to benefit one company. It should be to benefit a lot of companies in a token economic infrastructure, that you've got the monetary system figured out and it works. And it either doesn't need a company, like Ethereum doesn't need a company, it just has companies that support it, like Consensus. Or if it has one company, then you should probably have equity and have tokens, if that's part of your business model, and have a way that they're protecting each other. For example, having an equity board holder on the token company and vice versa. And this is just starting to develop, and Transform is in the process of finalizing Transform Studios Bermuda, because we're big fans of what they do there. And that's one of the best ways of being able to have a regulated token. I thought I'd turn this off. Okay.
He interrupted you.
I'm done.
Okay. Yeah, so I think the interesting thing about Transform Studios is that as you launch your digital assets or your traditional security type assets, in this world, you also have to worry about the jurisdiction and not just where you launch it, but how are you distributing this globally, who's investing, et cetera. And Mike has done that for several years with the Transform Group, kind of figuring out the most optimal business models as the environment shifts. And one can say it shifts every quarter, but it shifts more like every week sometimes. So have you, Randall, did you want to comment about?
No, let's keep it rocking.
I
we're
want to
gonna
see
keep
if
that horse.
what do you guys think about IEOs? That's called, kind of like an IPO, but on a decentralized type world of crypto exchanges.
I mean, I'll start. I mean, I think like everything else, or we touched on government a couple of times, the concept sounds good. It's the execution that matters. And so there is like what's actually happening in kind of the crypto space and then what the public perceives. So, yeah, you can do an IEO on Binance, but there's a lot of, you're going to give them 30% of everything you own. You're going to, they're going to, price it a certain way so they can cash out of everything. There's a lot of manipulation and insider stuff going on. So if you do it and it works for you, great. I mean, I think that's the beauty of all these systems. Whatever works for you as an entrepreneur, as a company, or whatever, then there is usually something that you can, whether it's an ICO, IEO, STO, or I'm going back to the last question. Wildly supportive of just straight equity. If you need a digital asset, great. It should be a product that complements a real business model. The token economics is a nightmare, and it's something that you'd have to spend a lot of money, like you would spend a lawyer on, whether it's Prism Group or something like that, to really understand what you're doing with a token, and it better have a real use case. But funding, I think, is going to take the way of what traditionally venture's been doing for a very long time. It's going to be a flight to credibility. I think what you saw over 2017 was a bunch of entrepreneurs that were taking easy money, and a lot of people got screwed. A lot of people made a lot of money, so hopefully they'll invest in the next kind of wave of what comes next. But I think Michael is right. The projects that actually have a real use case and have real value and have real people actually working on something that is real can absolutely find funding. There's funding out there, but the days of the easy money are becoming increasingly hard.
But let's look at that equity model world, because I spent my whole career in it, and it started like when we launched the KPMG Accelerator, where Mike's company was, Brock's company, all the crypto greats were early in the internet space. We were in a space that had top-tier VCs looking at the quality deals that you're discussing, giving entrepreneur a shot, right? Giving them the first deal that Mike signed with Sequoia and Hummer Wimbledon, those were good quality venture capital deals, but they were win-win deals. It wasn't like the VC owned the board and the entrepreneur was the employee after starting something from nothing. But then as the whole unicorn space developed, the whole equity market shifted into this completely non-win for the entrepreneur, win for the investor space, where, all the really top-tier money went into unicorns. If you were trying to fund a startup, it was very hard to find any money. You had to have a proof of concept, you had to have users, you had to have revenue. Basically, they were commercializing something, not investing early on. And then the deals became just so crazy. You had, basically you could take that company over with 5 or 6 different deal points in every contract. So don't you think that kind of created this, opportunity that we're living in?
Well, I would say that, it's a pendulum, right?
Yeah.
And just like fashion or politics, I think the VCs got too tough on their terms, and some people who are used to dealing with the VC models decided to go tokens. I think this was the start of the shift to saying, we don't need the VCs, was when Vinny Lingham, who had sold his last company, Gift, that was a client of ours, to First Data for like $70 million. They promptly shut it down and just took the customers and got them away as competitors. But they just kept the non-crypto part of it. He went out and started Civic. He got, with his credibility, serial entrepreneurs, everything he's done has been a win. He easily got his pre-seed round of $3 million. He built a prototype. He was going to use Bitcoin as the mechanism. He then, did what he said he was going to do. He got a full seed round of like $7 million. He then got to the point where he's ready to do a full launch of the product. Nobody in Silicon Valley would give him an A round because they said, well, A rounds are supposed to, they went back to the book, A rounds are supposed to be about Excel spreadsheets, not PowerPoints. Where's your revenue? Where's your profits? Where's your growth to 10 million users? And he's like, we haven't launched yet, but this is going to be gigantic. Same time, literally about the same month, the founder of Mosaic, Brendan, and I forget his last name now, he started this thing called the Brave browser, which was a browser, wonderful product, by the way. It's you know, it'll do everything that Mozilla and Chrome do, but it'll block ads, and you can actually earn cryptocurrency. Originally, he wanted to have it that you could earn Bitcoin to block ads. He, again, got like almost a clone, like got a pre-seed round, I think it was 3 or 4 million, built it, then launched it, and had maybe 10 or 20,000 people using it, but no revenue. Went for his A round, they're like, where's your revenue? Where's your profits? Where's your whatever? And so both of them said, screw it, we'll do a token. Brave Browser's token now, BAT, is worth about $400 million. They both ended up raising about $30 million to give up no equity whatsoever. They still have an equity component. I mean, I'm not against equity. I mean, the first company out of Transform Studios is something developed by our CTO, Jim Blasco, who we've done work for hire for other tokens, and he had an idea about how to go and develop something that would be a better counterparty on proof of work, and we have we've got the patent pending for 51% attack prevention on proof of work, and we have that integrated into this coin. And it also, because it's based on counterparty, will give you a almost zero fee Ethereum alternative that can run any ERC20 contract. We did equity first. Did equity because we didn't have a product. We went to accredited investors, and we were able on a couple $100,000 to build a product. Now we're going to do an ICO in Bermuda because it's ready. I think that, and they end up with their equity getting an airdrop of the token. And you know, I think that that's an area that is not as well defined as it should be. If you're an equity investor and you haven't sold the token to anybody else, it's worth nothing, just like your stock's worth nothing. An airdrop should not have a tax consequence, and you're giving it to equity investors. That's what Silicon Valley should be recommending, instead of like, boogeyman, just take more equity. Or the worst advice is do equity as a token. Oh my God, Reg A token, never been approved. Do equity as a company, you know, whether it's angels or VCs, and then do an airdrop or go offshore as a token until the U.S., you know, I don't know, fires Jay Clayton or something.
Are you going to allow U.S. investors in that ICO? The one in Bermuda?
No, of course we have to block them.
Yeah.
No, you have to block all the investors in the U.S.
unfortunate.
But as soon as they're on an exchange, then they can buy it there.
Yeah.
And I just want to throw in, I don't think it's actually bad that the sort of investor environment has shifted so that you have to be farther along. I think the technologies have moved forward so that just building things is easier and quicker. And really, it's not just a technology world thing. I think in the music world, for instance, like you'll never get a record deal unless you already have like 10,000 monthly listeners on Spotify or something. You already have to have like gotten it going. And I think that that's actually making people better. And I remember in 2017 when we launched Cent, there were a lot of things people were doing that we didn't think were a good use of time, like white papers. We always thought that was like everyone was spending so much time on white papers. And our pitch to investors was, well, we have a thing out and it's growing at like, you know, all this % per month. Like, do you care about a white paper? And they're like, no. And so I think if you just kind of focus on like, just make a thing, people want to use the thing, people will respond, and yeah.
But a meeting with Tim Draper, you had to have a PowerPoint at least.
No, we didn't.
You did not.
No.
That's the first.
They have a product, it's better.
Yeah, no, I think that you just kind of have they can use it, and if they get it, then I found that that's better than most things.
Wow, that's awesome. I don't like white papers myself. I thought they were more like PhD thesis.
Well, Jason Calacanis says don't show up unless you have a working prototype.
That's awesome. Okay, so this is, you know, it's a very interesting thing. So you don't think entrepreneurs should even try to raise money unless they have something going already that has users? Is that what you're saying, Ben?
What?
Ben's going yes.
Yeah, I think so. I mean, I'm just just kind of echoing your sentiments here. I think for people who are investing, you know, from an investor's perspective, I mean, we're looking at deals that will at some point make us money, right? The higher the probability, the better it is. It's great to have a good concept, but at the end of the day, it's about execution. It's about being able to bring it to fruition. If the idea is so good and the execution is so good and the team's so good, they should have probably figured out how to get closer to a working prototype before they have to go ask for money. And if they can't even get there, is that team really good from an execution or an idea perspective? I mean, that kind of starts the question. Nobody's going to have this really, really awesome idea that they can write a white paper on, but can't find anybody to support them or work with them on, and can't find any of their own money to try to at least build some steps towards showing that it works. So, yeah.
With Aspire, I mean, we didn't go to VCs. We didn't even go to, professional investors. I just, I put money in, and I told a few friends who said, hey, what can I invest in that's like really early stage? I was like, well, I'm working on something with my CTO, and they're like, can I put money in? I mean, so, and it was, because it wasn't built yet, I mean, it was $1 million valuation, right? I mean, I just looked and said, what does Y Combinator, value ideas at, right? And, and then they end up getting airdropped something that's, probably going to go out at, I think they'll do well for their equity investment. But they risk that it goes completely belly up. I had one other non-tokenized company that's purely an equity play out of that same incubator, and it's still chugging along, working, trying to find a business model, right? But if 1 out of 2 out of the incubator, B-Commerce Labs, which one of them graduated to Transform Studios, it's a 10x. That's way ahead of the curve if the other one goes to 0.
So it almost like what I'm hearing is that you need to be just as hardworking and entrepreneurial as ever, but also be creative in the way that you think about fundraising. So, and so far we talked about the tokens on the utility side. What about the STO? I know it's more of an academic discussion, but what are your thoughts about the whole STO fundraising opportunities, and what companies should have security tokens?
I'll kick off here. I've actually done an STO, so I think that's probably a good basis. We look at what we're doing in the fund space in terms of fundraising, in terms of creating fund, and what we like to see is we're trying to for our fundraising side, in terms of our VC fund and our product creation process, we're trying to create investment products, and we think that using the tokenization technology makes sense for us. We're using the STO kind of technology / framework more for asset-backed things. We're basically creating containers and funds and investment vehicles, and we're tokenizing that and offering that to clients. And that gives clients the flexibility of using the blockchain and tokenization technology for their investments. It is different to a certain extent, to a large extent, from kind of a lot of what we talk about in terms of the ICO world, in terms of utility tokens. Is actually almost a complete separate discussion. It's driving back more towards the financial, kind of the traditional, financial business models, and it's boring to a certain extent, but it's legal, it's a way to raise money, and it creates, efficiencies for what we want to do specifically. So I think for certain applications, it makes a lot of sense. It doesn't make a lot of sense to create utility tokens in the STO framework just because SEC thinks that's the best thing to do. So I don't think that makes sense. So it's really down to, what do you want to do and how do you want to do it? And for asset-backed, kind of investment vehicles and so forth, and tokenizing that, the STO framework actually works.
Yeah, it's not just about what's legal, it's also about what someone's actually going to invest in, right? So for a while there, lawyers were in Silicon Valley were telling people do a Reg A plus on your token. One has never been approved. And so, great, you spent $500,000 on legal fees, but at least you didn't go to jail. Well, you wouldn't have gone to jail if you just shut down the company and didn't spend the $500,000 in legal fees. So I think for them at this point in time, because the SEC has basically not granted, to my knowledge, any of the ATSs yet to do tokens. And it's very, and they also haven't let any Reg A, which can be non-accredited investors, be approved. I think there's only 2 types of STOs, 3, I guess, including certain types of real estate and tokenization. But right now I'm finding that they're not competing that well against REITs because you're going after real estate investors, not crypto investors. And they don't understand it. They're like, why don't I just buy Starwood? So I think the 2 that make sense right now and that have had some traction are, number 1, tokenized limited partnership of a fund. So if Sequoia Capital said, hey, we're doing another $500 million fund, we're going to go to the usual suspects, most people never get asked, but we're going to take $50 million and we're going to go and tokenize, first come, first serve, We can do up to 100 U.S. investors, the rest foreign. Minimum investment is $250,000. You have no vote. It's part of just an LP that we're having within the fund. That would sell out really quickly because most people never get the chance to invest in a top-tier fund. So I think those are going to do well. The first STO was actually Brock Pierce with Blockchain Capital, and it sold out in minutes. I mean, he did obviously a roadshow beforehand. And it still not listed officially on U.S. exchanges, but there are places you can buy it. And it went at $1, represented $1 in a long-term investment in the fund. When crypto winter was kind of shaky, it went under $1, but you still had that asset to just keep and hold it. And at one point it hit $4. So you could, if it was in a jurisdiction you could sell in, you could go and triple your money and still have your original investment there. That's not bad. So that's sort of the exchanging the vote, which if you're not putting, kind of Stanford University endowment size money into a fund, you care more about liquidity than the vote. I think that's going to be very popular. And for the sake of this crowd, I think another thing that's going to grow in popularity is going to be revenue royalties, not dividends, royalties, where you actually have a predetermined cash flow, say completion bond funding. You only have this much left to finish the movie, last money in, first money out. You tokenize it, you have a stable coin behind it, you've got not just contracts you have to go to court or suit, but literally the money before it comes from the theaters into here has to go into your wallet. I think that's going to be a big thing for Hollywood.
I think that's a great segue to my next question. Thank you, Mike. So venture capital kind of funds big companies, ventures, et cetera, opportunities that are hockey stick growth and all that, as do ICOs, IEOs, STOs. But here in Hollywood, we have project-based financing. So what are you guys' thoughts, other than what Mike just pointed out, which is a terrific opportunity? What are some ways to fund digital media, next generation, film, television, music companies, things that are near and dear to our heart, AR, VR, et cetera? So you guys want to take that?
Yeah, sure. I think the points that Michael just brought up earlier regarding royalties and being able to have access to those future cash flows is an important part of how this could be applied to production financing and assets or new original content that's being created. I think another part of that could be pre-selling parts of whether it's digital assets in a franchise or in a story, so owners of those assets can kind of participate in the growth of the price of those assets as the movie comes out and is distributed, and there might be a game property attached to it. So I think there's a variety of ways as we look at blockchain and we think of financing productions that the ecosystem of buyers and stakeholders in the properties itself can create liquidity in that property or in that production specifically. So I think that is evolving, and it's very interesting. And we're looking at it, at Rogue Initiative Studios, where we're creating franchises that go across all those mediums. So that as you create a new property and you're looking at making it into a game and a film, that's where that kind of the transferability of that asset could be very interesting.
Yeah, I just want to throw in. I think I'm still a big believer that what we're moving toward is people being able to look at a preview of some project. So someone would make a trailer of a movie before they actually make the movie, for instance, and the crowd could sort of bet on whether they think the movie will be successful, whether they want the movie to be made at all. So things like Kickstarter, Indiegogo, I think that they're definitely a part of culture now, but I think they're just going to be more and more a part of the default way we do things. There'll still be the centralized funding sources for all these projects, but I think I still don't think we know how early on we are in the scope of project-based funding. And if a project in the future, again, I don't think all these token things, all these STOs and IEOs, I still think they're still too early. If you want to build like a long-term enduring thing, Just from my own experience, we raised our first round with this. At the time, everyone said you should use a document called a SAFT, and it's like a simple agreement for future tokens. And 9 months later, we were raising another round, and now everyone hated SAFs, and everyone was using this new thing. And so it just changes so quickly that it's hard to, in my mind, to say, okay, let's do this now, because in a year, the whole place might have moved, and if you use the old version, everyone's gonna frown at you. So my advice to people still is to do like what the structures at B have determined is definitely doable, but then to maybe have like an experimental, unless your thing is totally experimental, if you just want to if the purpose of it is just to see what happens, then do that. But projects too, I think if projects maybe are the best way to have the experiment because they're bounded. It's not like a company that you want to exist for a very long time. So yeah, I could see a lot of innovation occurring there.
But you're doing innovation with Cent because you're funding people, influencers.
Yeah.
Most of them create projects. So you're funding the projects.
Yeah, well, we're actually about to launch something where you can sort of invest in the creator themselves. Like if you saw, if you were at a coffee shop and in 2004 and you saw Taylor Swift and you could put $10 down and bet on that in the same way you could bet on Bitcoin. We're definitely in that path, but I think that's we're definitely taking some calculated risks because the world doesn't have any structure for knowing how that falls legally, and so we're sort of, I think, just like Uber a few years ago sort of had to take the brunt force of a lot of new structures in the world and had to fight a lot of battles. We've sort of accepted that as part of our whole company journey, but yeah, I think in general though. Leaning toward what most people will, to Michael's point, will actually buy and actually invest in is probably the quickest way to get moving.
What you propose in terms of a Indiegogo style Kickstarter, but having a revenue component and a royalty component available to the everyday Joe, would be a huge success if it was a Reg A plus with big stars attached. The SEC is afraid to go in green like that. And because I think they're afraid of the floodgates. Now you could do that right now as, Reg D only, but it limits it to 11 million, U.S. households who are going to go and say, well, I'm looking at this versus many other investments and blah, 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 and let me go and meet the Chris. Whereas if it's crowdfunding to the other 300 million people in the United States, and it was just I always find it shocking that, I lived for many years in Las Vegas. I still have a home there. They will not let you, the SEC, if you do not make $200,000 a year or have $1 million in assets above your home and all this stuff. So the vast majority of people in the United States, they will not let you go meet someone like Max and say, I'd like to put $20,000 into your next startup because I really believe in you. But they'll let you go and take more than that and go to Vegas and put it on red on a roulette machine. And there's no warning saying you may lose your money. you may not play this while you're drunk, So, I mean, I think it's just, an interesting, just kind of moral question why the U.S. allows Vegas to exist and doesn't allow, Angelina Jolie and Brad Pitt, well, I guess they wouldn't do a movie together anymore, but Angelina Jolie and George Clooney and Steven Spielberg to say, we need $100 million for this next blockbuster, and you're going to get the first money out of it until the token is paid out for the first $10 million, and then you also get free tickets in the front row and blah, blah, blah in your city. I mean, that would be amazing. That would do well. I think also when Reg A Pluses actually are approved, one of the big future opportunities, I've said this for a long time, is for restaurant expansion. Being a restaurant owner of a hot restaurant, take something like, I give in LA the example of Tender Greens, right? It's always got lines out the door at a couple locations. I'm sure to get their funding, they had to go and have dinners with angels, month after month after month. They finally got their checks to write their first restaurant. Then they want to expand. The angels referred them to restaurant VCs. Then all of a sudden, if they want to get to the point of it being a public company like Chipotle, they have to go through other rounds and then private equity and then mezzanine round. By the time they go public, the entire management team is lucky to have 10%. Now, on the other hand, if you were able to issue to your rabid customers at a security token and say, hey, it's a hybrid security and loyalty token. If you hold on to the stock, you get a 30% discount on all your meals. At this level, you get free meals if you have this much, or whatever the ranks, 10, 20, 30, probably can be free. But, and then you have that in your wallet. It's a security with other components. You can go and dictate your own terms on your A, B, C rounds, and that's really democratization. And if you're a good product that people love, the bad ones will fail because people don't like their food and they don't have lines out the door. You could probably end up, by the time you get to Goldman Sachs and do a traditional IPO, having the management team having more than half of the equity.
Yeah, and you can also simulate what a digital asset would do without actually having one, which is kind of what we're doing, which I think gives you some nice buffer from the legal requirements. Like, for instance, again, with our model, where you give money to something and then you get money from everyone who comes after you, we easily could have made that like you get a token and then the token like issues a dividend or something. But the thing is, when you have a token released, you can't really change the code. So the way we did it was that it's just sort of a series of interconnected contracts, and the contracts can be updated if needed. You can read the code of the contract if you want, but I think it's important for people to look at, like, okay, what's the end state experience we want for this asset to give to people, and is there some way to do it without actually having the asset exist? Because you can still do it in a decentralized way, but it seems like the line often legally is, oh, it's an actual asset, now it's actually something you own, now we have to make a regulation, or now you're in trouble, now, and if instead it's just dealing with contracts, which I think in general is way more legally permissible because people are engaging essentially with code that they can look at. And so it's pretty, at least right now, it doesn't seem like that's something that they're really bringing the hammer down yet on. And you can always update it, you can always change it, you can always evolve it, so just like any other software. And so not that that would work for everything, but I think for a lot of things, just routing money in interesting ways can do a lot that an asset could do.
So it's like a digital assets 2.0 without the token.
Yeah, just a
we
digital
heard it
structure.
here first in this panel. Okay, so let's think about for just a
It's
moment.
actually Back to the Future. There were smart contracts before there were tokens.
So, quick question we have 3 minutes left, but maybe like if each one of you can just give us a 1 minute quick summary of like the greatest thing you're looking forward to in the next year of blockchain or crypto. Like, what is the biggest innovation? What's going to happen in your mind that's really exciting? Ben, you want to start?
Kind of back to my looking at tokenization of hard assets, and similar to what Michael was saying with regards to kind of VC funds. I think that applies generically. Anything that's an appreciating asset could potentially be tokenized. We're actually looking at tokenizing whiskey, so that's pretty interesting. I'll leave it there.
Is that your STO?
We've done one. We're in the process of doing many more. That will be one of them on the roadmap if we figure out everything, all the details.
That's awesome.
Yeah.
Thank you.
I think what I'm most excited about is it feels like there's a lot of true conceptual progress that has been made within the crypto world that the mainstream world is just unaware of. And so there's this huge delta right now. And what I'm most looking forward to is packaging that into an emotionally resonant way for the mainstream world and hoping to start to blur the line so that there's not just the crypto world and then everyone else, because the crypto world is just so small. And doing things maybe on a PR level, maybe on a stunt level, maybe on just something to get into mainstream consciousness. And I think we're not the only ones trying to do that, but I think someone will begin to pierce that veil this year, which will be exciting.
Yeah, think how early we are. We have not had the Uncle Milty moment. We haven't had the, I need a television so I can watch Milton Berle. We haven't had the, I need an iPhone so I can play Angry Birds. I mean, nobody's like saying, oh, you're not a cool kid because you don't have this crypto, right? This will happen at some point, and it may be a game, it may be sent. Right now, it's not like, oh, well, you're not cool because you can't go and take a decentralized token and send it to somebody in Germany in 18 seconds. I mean, what? After the 60 Minutes piece on Bitcoin, Google hit a record number of searches on Bitcoin. It was interesting. Didn't know that many people watch mainstream television anymore. What I'm excited about is a clarity of understanding globally among regulators and an increase in power of the people who are doing things in blockchain and digital assets, so that it's not a one-sided conversation of banks saying shut everyone down, and an evolution of sort of permissiveness for things that are not bad actors and bad behavior, instead of this digital McCarthyism that we have right now, finding a unregistered security under every couch. I think that it's not just the U.S. Obviously, Korea, which was very pro-digital asset and then kind of became anti-digital assets, evolving back again. I think that a lot of them are just afraid of opening Pandora's box, or as I like to call it, Pandora's blocks. And name of my next book, by the way. I have an agent. I just have to write the damn thing. I think that is going to just really explode the nascent demand, and watch out when that happens.
The thing I'm excited most about is when we don't have to make users go through a cumbersome process to be able to get the advantages of blockchain. So, the thing I get most from users and people in general that I talk to is, I don't understand how to create a wallet. I don't understand how to do this and this and this, so I'm not going to do it. And when we can, make that technology seamless or more seamless, and that's happening, and it's, happening on Superworld, and we just integrated with Portis, that's allowing us, people to go right away and do this process more seamlessly. And I think as that happens, and we don't have to explain things, and people can get all the benefits and just, are able to interact on platforms without kind of worrying about the technology, back to what was said earlier, that is what I'm excited about, so the most.
That's like everybody here old enough to remember dial-up modems, pretty much? You don't have to dial this thing up. You don't have to have a second phone line. Because when it was 14.4 dial-up modems, I had a lot of people in Hollywood say, we're never going to be on the internet. My mom is not going to go get a second phone line and get woken up in the middle of the night by this thing going bing, 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 bing. It's like, here, Mom, here's an iPhone, watch Netflix.
I'm excited about the credibility. I think that, for anybody that's been in venture invested, angel investing or whatever, been an entrepreneur, starting companies is hard. I love, we're trying to decentralize data to kind of remove the power base that people like Facebook and Google have over data, because it's probably one of the most valuable assets on the planet. But it's very hard to decentralize leadership. Companies, I have some remote employees, and we have about 200 employees. Some of them are remote, but having an executive team that is kind of, one team, one fight, the life cycle of a startup is going to punch you in the face multiple times. There's going to be multiple things that go wrong, whether it's from financing to product development to hiring to everything else, and that's just tough. And I saw a lot of people in 2017, pretending to be an entrepreneur. A lot of teams that kind of came and went, probably never even met, and some of them were just outright scams. And so it's exciting. There's always been, people like folks like Vinny and some other folks that have, successful entrepreneurs that were in the space, before the space was cool. But now that the space has gotten attention, I'm excited to see kind of the professionalization of it and some of the really strong entrepreneurial teams or existing companies with existing products figuring out how to leverage this to bring it to the mainstream in a meaningful way that people can actually use. And I think you'll start to see more and more, at least for us specifically, dual token economies, because the SEC has kind of made all of this problematic, and so people are going to get more thoughtful in how do you create this ecosystem that actually can work when it does reach the mainstream, and there's millions of transactions. Nothing really can handle, true consumer scale. There's not really blockchains that are built to do that yet. So the credibility of teams launching real world, digital asset ecosystems that solve real world challenges, and their actual companies kind of leading that effort and not just, pretending when it's cool.
I'm excited about so many things. It's hard to summarize in one sentence or two. But one of the things that I've seen is that Fortune 500 companies are sort of doing a round robin on that list, and in the next 10 years, over 50% of them will be off the list. And I'm excited to see companies on this panel and all the companies we work with, and in Mike's networks and Bid Angels networks, et cetera, coming to become, those next generation Fortune 500 companies with all the things you described, and but yet overturning the man, as they say, and making it a more, I would say, humanly focused world versus, this sort of ownership of your data and very centric, Google and Apple and Amazon-centric world. So I'm with you.
That's why we went public. It's more about credibility and transparency for us, and telling people, hey, here we are, here's what we're doing. You can have all the information that everybody else has, and it levels the playing field.
So I want to thank our panelists. We ran out of time. I want to keep them another hour, but Victor won't let us. He does have another panel in here. But maybe we can reconvene in the fall and discuss what happened and how good we were at predicting everything. Thank you for joining us today. We have another panel.